Well, Alphabet shares in the red despite beating on the top and bottom lines. Let's bring in Evercore ISI's Mark Mahaney. Mark, shares are down 4% right now. We talked about the fact that cloud revenue came in a little bit better than expected. But Google services, it looks like, also slightly better than expected. Advertising maybe a little bit light. And YouTube ads, it looks like, largely in line. Why do you think the stock's down as much as it is right now?
Well, Morgan, I think you set it up right. The results came in better than expected, but not from search revenue and not from YouTube revenue. And there were a lot of expectations chatter on the market that both of those were very strong going into the holidays. So expectations were high there. I don't think there was a dramatic miss, but this was a high expectations quarter where they did positively surprise me and some other investors, but definitely me, was their margins came in better than expected. There's a $1.2 billion charge. You take that out. Margins were very solid for the company. I give them credit for that. My guess is that overall, numbers will probably go up on the street on these results. But yeah, the expectations were high on the advertising side, and they just met them. They didn't exceed them. That's why the stock's pulling back.
Yeah, I'm glad you called out margins, too, because we know OPEX costs, cost cutting, that this was going to be in focus with this name as well and what those ongoing efforts look like. And we did get the commentary of, quote, we remain committed to our work to durably re-engineer our cost base as we invest to support our growth opportunities. What does that potentially mean? And I guess how do we know yet? Or I guess what are your expectations in terms of what that balance looks like versus what the street would like to see?
Well, I don't want to be too critical, but there was a cost religion memo that went around Silicon Valley, and it almost seems like Google sent it back. I'm being too critical when I say that, but what the market would like to hear is, will you make a commitment to running your OPEX growth at a lower level than your revenue growth, i.e. expand margins, and the company's not willing to do that. They have a lot of good reasons for not doing that, but in this day and age, companies get rewarded for really managing much more aggressively their costs. That's what happened to Meta this last year. It happened to a good number of other stocks, Amazon too. So the market's willing to reward real, good cost discipline, more aggressive cost steps. And it doesn't seem to me, I listen to that language, it's the same language that Google has made over the last, couple of quarters. There's nothing wrong with it, but it's not what the market really wants right now.
Mark, about that, I wonder, because you mentioned Meta and Amazon, both of them got themselves into major trouble on the cost side. Amazon when it comes to building out the warehouses, Meta with its metaverse emphasis for a while, still spending on that, but not emphasizing it much. Google doesn't guide. So what's it going to be on the call that's going to convince the street one way or another how to interpret these inline numbers in, as AMD has described it, a mixed demand environment?
Well, I do think the demand environment's actually improving for advertising. So Google's got that in its sales this year. Don't forget, the Olympics, the elections, you got easy comps in the first half of the year, and there are a lot of AI improvements that are occurring across internet land. But you're definitely going to see it at Google, and I think at Meta too. So there's a lot of sales here. I'm not worried about the demand environment. I'd like to see a little bit more aggressiveness on the cost side. But that line that Morgan read, from the company, I think that's kind of Google's stance on costs. We're going to make long-term investments when we want to, when we think it's necessary. Look, they've done a very good job with these investments over time. I give them a lot of credit for that. It's just that the market's a little bit more fixated on cost in these days, especially as these companies get older and the growth kind of becomes a little bit more pedestrian. It's not 20% growth. We're 13% growth, and that's good, but it's not super great. And so in that environment, you need to be a little bit more judicious with your costs. And I just don't sense that. I don't think the market does from Google management. Maybe that will change with the new CFO, but I don't have great hopes for that at this point.